Hello folks, Steve Lentz here with the Inside Wire here at Discover Options. Welcome. It is October 3rd, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All right. Someone changed the chair out in my office and kind of freaking out over the settings here, so excuse me here. So we are on part 4, and we were dealing with upside adjustments. We have our final installment of upside adjustments, and this was a last idea that I bounced off Frank a while back, and so we're going to go for it here and discuss a leapfrog approach to adjusting. Now let me change this thing back. There we go. All right. So just to review real quick, we're looking at best practices broken wing butterflies. We put on the initial butterfly in this sense. We go out 60 to 85 days. Just as a brief review, our short put is at around -30. We go further out of the money, roughly 5% of the index value. And then we go towards the money or even slightly in the money, the level that we need, such that we have a delta coming to approximately 0, while at the same time keeping our entry debit less than 5% of the initial capital required. All right, we favor S&P 25-point strikes in the SPX, more liquidity there, and we walk into risk. That is, we're going to scale in halvesies at a time. First half, then we walk in with the second half. So we had an example that we displayed every time, and you could just go back and look at the, part 1 is where we dive into this particular example. The notion here is that in this particular case, we're at 25-point strikes. You put on those first 2 legs, the one at the -30 delta, then you go out 5%, and then you have the delta that you're going to adjust to. And so then we walk up here, buy a 5 lot at this delta at 45.4. That scales us down to about 0, and our debit is less than the 5% level at about 3.5. So we're good, and when we analyze that, we want to use, for purposes of comparing it to other, other strategies. You want to use the volatility input here in the SV box, according to the Inside Wire methodology. We discussed it on May 23rd of 17. And that gives you a more accurate estimation of what the downside move could be. And so when we analyze it, it looks real nice. And of course, what we did is we compared this to other butterfly approaches going out 30 days. This is the one that we have settled in on as the methodology to initiate our campaign. And when you compare it to the Rhino, the Road Trip, and the Kevlar, here we have the best practices in blue. You could see that certainly it doesn't, if the market doesn't move at all, it's making the least amount right there. But when you factor in the bell curve of possible price outcomes using an accurate downside estimation of move for a move, what you end up with, both in a high percentile and a low percentile IV environment, is that the standard deviation is the lowest using the best practices. It beats 2 of the other 3 in terms of expected return, and it beats the Kevlar in the high one, and then the low IV one, it underperforms it just a little bit, but again, the standard deviation is a bit lower than all the other 3. So it works out really well that way. Now, what do you do when the market goes up? We've explored a couple different things, and I won't review those. You could look at parts 2 and 3, where we explore things like the reverse Harvey. We've added a call butterfly. We've done a number of things, but here's an approach that Frank and I discussed here about a week ago or so that proves promising and is a bit easier to execute. And that is just the leapfrog approach. And there's other educators and researchers out there that talk about a leapfrog in various aspects and different methodologies. But here's the one that we just came up with, and you'll see it's pretty easy. So after we scale in the other half, okay, if the market keeps going up, after, we scale in, if the market goes up, we scale in the other half. After that, when the market moves to certain levels, and we'll go over what those levels are, we would remove the butterfly that has the most distant short strike and replace it with a new one. Fairly straightforward. Market keeps moving up and up and up. You just go down to that most distant butterfly. In this case, it would be the initial one we put on, and the market's blown past it. Well, we're going to remove it and put another one on, closer to where the market is. And we keep doing that until the market settles down, chops around, we gather some theta, and we're good to go. And what we do is we target a certain profit or loss level. And for this example today, I'm just going to show you an example where we go, we're just looking for simply 5% of the total capital required after you scale in the other half. We're gunning for 5%. Okay, if we're ever down 5%, well, then we would get out. All right, now when we do a more comprehensive back test, then we'll get examples of that happening. And then I'm putting in here just a 30-day time stop, days to expiration time stop. I think Frank has, 28 days or something like that. We'll just round it to 30. We did not hit that in this example I'm going to show you today, but let's see. I was testing your chair. Jim, you're the culprit. You were testing my chair. Testing for what? Frank, I'm sorry, Frank. I just saw your comment, and that question is to Jim. He was testing my chair, maybe to see if mine was better. I don't know. We do have a variety of models here. Two models in general, and so I can understand it. It's two models in my office. Okay, now Jim's typing something. Here we go. Oh, you bought a new chair, Jim. Excellent. Okay. All right, so let's go forward and let's just see this example. And we always have begun on a day just before the market blasts off to the upside, so we can just come up with an approach that makes money even in a market blasting off to the upside, and just see how well we would manage a big upside move. Now, the approach today for leapfrogging would apply to the downside as well, so that those examples will be forthcoming. But we've begun on February 8th, and here we're going to see that the market's going to take off, and when it takes off, and what we're going to do is make our adjustment points. Initially here would be the short strike to the downside. If the market moves down and hits that short strike, okay, we're going to add a butterfly down here. All right. And if the market moves up and it goes more than 1% above the expiration break even here, well, that's when we would go ahead and add another butterfly here and keep it going. And so we're waiting to scale in, see which direction we're going to have to scale in our second half. So indeed, the market does move up, and it hits on February 13th. So we're putting this on the 8th, and on a Wednesday, I think, and then this is the following Monday, and the market moves up and hits our 1% above that expiration break even, and now it's time to put on another butterfly. And here's how we scaled in our second broken wing butterfly. We're going to the delta of 30. Same thing, going 5% out of the money. Oh, Jim didn't like my chair. It's good for your back. You don't want it to feel too comfortable. After you go further out of the money, you have the delta adjuster for the whole position. Okay, and of course we're favoring 25-point strikes when we can. So in this case, we added on, here's our initial butterfly. We put on the 30 delta short strike. We went 5% out of the money, okay, and went long that one. And then our delta adjuster put us at right here. Now, the first long strike was right there. Our second one, the delta adjuster, was right there. It kept our total debit under 5% of the total uh, of the total capital required. Okay, and here we go. Now, where are we going to go from here? Where are the adjustment points at this point? Well, at this level, what we're going to do is set our next adjustment point 1% above that expiration break even. That's not too far away. But at that location, we are quite far away from this one, the initial butterfly. So the market's moved up quite a bit already. We're giving it a little bit more before we start our leapfrogging. And then, of course, on the downside, we're going to put it at that short strike most distant. Okay, at which point we would start leapfrogging a little bit there. Okay, and maybe that rule will change when we start examining downside moves. We might make it here, but this is relative to the 10. We're not looking at, this is an important distinction. We're not studying the Greeks here and using ratios of theta to delta, etc. We're looking at it relative to the tent. So that's an important distinction using this approach for definitions as to when to make a move. So here we have the market then going, this is on February 13th. The market then, okay, let's see here. That's right, the market did move up on the 13th. Our trigger was hit. What do? Okay, we remove and replace. Oh, this is on the 15th. It went up by the close on the 15th. It did move up to that 1% above this point. And now it's time to make an adjustment. So we're going to remove the butterfly on this short strike, and then we're going to move it up. Now, where do we move it up to? And this is where my time was spent. I went through this looking at putting this new strike at a delta of -30. Let me make that a little bit more clear. I was leapfrogging using deltas of -30. And I went down the road quite far when I realized that if you did that, you're pretty much always leaving yourself a very thin area up here. All right? And if the market keeps moving up, you're constantly in this little, I'm gonna call it just, low. It's technically positive theta, but it's the positive theta is very low. I'm gonna call it you're just chasing the market a bit. And it was driving me crazy, and the profits at the end of several weeks were really at nothing. We just kind of scraped along here as the market was blasting off. The rest of the world is happy as a clam. The market's moving up, and here this strategy is making nothing. So I rewrote this and retested it and have a new example here where instead of moving the old butterflies here, replacing it with a delta of 30, no, what we're going to do, oh great, I'm trying to be slick with my the use of, there we go. Instead what we're going to do is go to -40, okay, and that'll move it a little bit farther up and put us then hopefully under the tent just slightly, rather than scraping along here outside the tent, but with positive theta. So here's what we do. We replace the old broken wing with a short put that is closest to -40 or less, okay, meaning we go to, well, or more, I guess I'm going to qualify that. You could go down into the 30s, okay, you can go down into the 30s. And as I said here, using a -30 delta meant chasing the market a little bit too much in these big up moves. We do the same thing. We go 5% further away. We use the delta adjuster, and we try and keep that 5% of the delta of the debit for the capital, for the total capital required, and we're favoring 25-point strikes. So in this example, we ended up going to this strike here that had a delta as close to 40 as we could get. We went further out, way out here. Let's see, I think this was, no, this would have been the second strike. So this is the further out of the money strike, and then this is the long strike right here, the delta adjuster. And so this put us at we're well under the 5% of the total required. So we're looking good there. And that's what we're going to do now. At this point, our new adjustment points are here at this short strike. Okay. And we go on another 1% above the expiration break even, puts us at this red dot there. And so now we have a nice little area where the market can chop around a bit, and hopefully Theta kicks in and we make some money. All right, it's fairly centered. We're delta neutral, close to it anyway. And if the market does move down over time, you can see we have that nice little lift at the midline there, T plus 34. So all in all, looking good. Now what happens here from February 13th onward, all right, going to March 1st, it slowly chugs its way upward. And we never do hit that 5% profit level. But on March 1st, right at the open, it gaps up slightly a little bit beyond our 1% above the expiration break even here. Okay, it went just a little bit beyond our target. And we're now ready to do something. What are we going to do? We're going to get rid of this distant butterfly and replace it with something near a delta of 40. Okay, now watch this. Let me make sure you got this. Yep, that's what happens. So do you see this long strike right here? That little elbow? Well, when we're moving our short strike to a location beyond that little elbow, we're going to get a strange looking pattern. It's going to be different than the intuitive pattern that you see here, where we have our short strikes here and both longs outside of those two. Okay, now that we're going to overlap our short over this long, we're now going to have a strange, an unintuitive or an inintuitive, well, I don't know what the term would be, the best term, an unintuitive shape to the expiration line when we do this. So we go ahead and do this. We go to the minus 40 strike, something close to the minus 40. And when we do that, okay, there it is. It creates this shape. And you can see here that the T plus midline is something we're very familiar with. But the expiration line looks a little bit different because we did that little overlap. That's just simply the way it worked out. And we set this up. We're neutral, delta neutral. Our T plus midline has a little bit lift on the left side. Our new adjustment points are set 1% beyond expiration break even out to here. On the downside, we're sitting at that short strike way over here. Not too bad. And that's it. That's what we're going to then wait for. And hopefully the market chops around for a bit. It stops its upside tear. And Theta kicks in. And indeed, that's what happens. Here we are on March 1st. Okay. Oh, and here I overlap these two. So you can just see I got rid of this butterfly and added the one here, and this one remained, and this is kind of what it ended up at. Okay, it puts us under the tent, which is a good thing. And so what happens then from March 1st to March 13th, the market does not hit either of those targets, adjustment triggers, and indeed we look up here on March 13th, with 39 days remaining in the life of these options, and we have just over 5% profit available to us of the 64,000. And so that's when we would remove the position, take our 5%, and be very content. So from February 8th to March 13th, the campaign made 5% here. And the market, when you look at a chart, was just on an absolute upside tear before it chopped around a bit. And so that is an example of the leapfrog going to the upside. My next task is to take those rules and apply them to both upside and downside and begin a more comprehensive back test. Of all the upside adjustment approaches we looked at, I tend to favor this one. This one began making money and was in the positive for a lot more days than doing those other two approaches. Execution should, would be easier. Putting on butterflies, taking off butterflies, and not doing the reverse Harveys and then adding spreads and all that, any debit spreads or credit spreads, as is what is a common adjustment, especially on the downside. So on the downside moves, we're going to take a look at doing this leapfrog thing, and we'll see how it pans out. Any questions, comments? I could have showed you, actually I made a ton of screenshots using the 30 delta, and it was just an exercise in chasing the market, and I got rid of several screenshots as to that exercise, and I said, you know what, let's try 40s, and it worked out a ton better. So that's why I'm happy about this. I'm very up on this approach here. Okay. Great translation of the Frank dialect. Okay. Awesome. All right, folks. Thanks so much. We'll be back next week with part 5, doing a more comprehensive leapfrog study. Thanks a lot. Take care. Have a great rest of the day. Bye-bye.